If the market feels confusing right now, you're not wrong, because what we've been through over the past few years hasn't been one market. It's been a series of very different phases, compressed into a short period of time. So instead of just focusing on what's happening today, I want to zoom out for a minute and walk through how we actually got here. Around 2017, we saw the first major policy intervention, the Fair Housing Plan, the mortgage stress test. You might remember how quickly things changed then. Open houses slowed, bidding wars disappeared almost overnight. The market cooled fast. Then things settled. 2018 into 2019 was actually more balanced. Not a lot of headlines, not a lot of urgency. But if you think back, that was a window where people who did act ended up doing very well over the next few years. Then came the pandemic. Rates dropped. People started wanting something different from their homes, and suddenly, everything accelerated. Multiple offers everywhere. Homes selling in days, sometimes hours. And it felt like if you didn't act immediately, you might miss your chance entirely. By early 2022, we hit the peak. Rates rose quickly, and the market corrected just as fast. And you could feel it. Phones stopped ringing, showings dropped off. Deals that would have been easy a few months earlier just weren't happening anymore. At the same time, higher rates started to show up in a different way. Monthly costs rising, cash flow tightening, and fewer easy decisions. And even as rates began to ease, it happened gradually. Not enough to restore confidence, just enough to relieve some of the pressure, but not enough to get people moving again. Since then, we've been in a different phase. Prices have mostly held, but activity dropped off. And instead of urgency, there was hesitation. Buyers waiting, sellers waiting. Everyone trying to figure out what things were actually worth again. And this is the part that matters most. The market doesn't move because of headlines. It moves when the gap between buyers and sellers changes. When that gap is wide, nothing happens. When it starts to narrow, that's when deals start happening. That's when the market actually moves. And what we're starting to see now is not a surge, it's not a crash, but we're starting to see early signs of alignment. And a big part of that is confidence. Not just interest rates, but whether people feel ready to act again. Now layer in what we're seeing from a policy perspective. Some of the recent changes, like HST adjustments, are really about the short term, trying to bring buyers back and move standing inventory. But the more important shift is structural, reducing development charges and levies, potentially by a significant amount, changes the economics of building. These costs have been rising for years, and they've quietly become one of the biggest barriers to new supply. So this isn't just about clearing inventory, it's about whether supply actually shows up at all over the next few years. At the same time, the market is adapting. We're seeing institutional buyers step in, buying up unsold units in bulk and converting them into rentals. That doesn't mean the market is broken. It means the way inventory is being absorbed is changing. And not every part of the market is behaving the same. Some segments are still slow. Others, especially at the entry level, are starting to move again. So the market isn't frozen. It's just not moving evenly. And again, it comes back to alignment. And this is the part that's so easy to miss. These windows don't feel obvious when you're in them. But if you think back, the best opportunities rarely did. The data doesn't create the shift. It confirms it after it's already started.